This video covers the basics of revenue recognition. We'll talk about when companies recognize revenue, and then we'll go through some of the journal entries and T accounts involved. First, when can companies recognize revenue? And the answer is, companies recognize revenue when they earn it, when it is earned. What does earned mean? Well, a company earns revenue when or as the good or service is transferred to the customer. Another way to put that is when or as the performance obligation is satisfied. And what do we mean by recognize revenue? This is what we mean. A company can record this journal entry. So once a company earns revenue, they record this journal entry. And this journal entry is a credit to revenue, the revenue account on the income statement. And the debit is to one of three different accounts. It could be a debit to cash, which is an asset account. It might be a debit to accounts receivable, which is also an asset account. Or it could be a debit to deferred revenue, which is a liability account. So these are all or. We record the debit to cash when we earn revenue at the same time as we receive cash. That's when the debit would be to cash. If we earn revenue but we haven't received the cash yet, then the debit is to accounts receivable. And if we earn revenue after we've received the cash from a prior period, that's when the debit is to deferred revenue. So let's go through some of these examples. First, let's go through an example where the payment is simultaneous with the revenue recognition. And the best example here is Target. So when you go into the Target store, you pick out a Trapper Keeper, costs $15, and you go to the checkout and you pay the $15 in cash. Let's talk about the simultaneity of what's going on. Target is earning the revenue. Why? Because they're satisfying their performance obligation of handing you the Trapper Keeper and you get to go home with it. So they're earning revenue at the same exact time that they're receiving cash. Okay, since they're earning revenue, they can credit the revenue account on the income statement, and they're receiving cash at the same time, so the debit is to cash for $15. Okay, next example. Now we're going to talk about when a company recognizes revenue before they've received cash. And here we'll talk about a Colorado company called Newmont. Newmont is a gold mining company. And what Newmont does is they dig dirt out of the ground, they process the dirt into gold bars, and then they sell the gold bars to a bank, okay? So when does Newmont satisfy its performance obligation when they're selling gold? Well, the performance obligation is the delivery of the gold to the bank. So the first activity here is Newmont delivers $1 million worth of gold to the bank. Now the performance obligation has been satisfied and they've earned the revenue. So they can credit the revenue account. Can they debit cash? No, because actually the bank hasn't paid them yet, so they can't debit cash. The bank owes them money. So what they'll do is they'll debit accounts receivable, an asset account. And accounts receivable just reflects the bank's obligation to pay Newmont money. It sits as an asset on Newmont's balance sheet until it's paid off by the bank, okay? Now, when the bank finally makes the $1 million payment to Newmont, Newmont will receive that in cash, so they'll debit cash, and they'll credit the accounts receivable, reducing accounts receivable to zero. Now we'll go through the final example, and that is an example. Actually, we're going to go through the T account for accounts receivable. So this accounts receivable asset account on the balance sheet has a debit normal balance, like all asset accounts do. And so you see the beginning balance of this account on the debit side of the T account. When the company earns revenue, satisfies their performance obligations, they debit accounts receivable and credit revenue. So here is that debit to accounts receivable. When the company receives the cash that they're owed from their customers, they credit accounts receivable and debit cash. So here is the credit to accounts receivable. And finally, something we're not covering in this topic, but we'll cover in a future topic, customers sometimes default. So think of the bank going bankrupt and not being able to pay Newmont. In that type of a case, Newmont or the company that has the accounts receivable will have to write off the accounts receivable with a credit in a customer default. And so here is the accounts receivable T account. It's got a beginning balance as a debit, plus any revenue that was recognized this period, minus the cash that was received, minus any customer defaults, and you get to the ending balance, which will also be on the debit side of the T account. Okay, the next example we'll go through is, now we'll talk about Newmont's balance sheet. So here's what it looks like on Newmont's actual balance sheet. Here we have the asset section of their balance sheet, and these are asset balances as of December 31st, 2019 and December 31st, 2018. And the account that we'll talk about is right here. The account is called trade receivables. Okay, that's just another name for accounts receivable. And you can see that this balance is 373, and it's in millions. So this is $373 million on the Newmont Corporation balance sheet as of December 31st, 2019. That means that banks who have been delivered their gold, as of December 31st, 2019, those banks owe Newmont $373 million, okay? So that's how you interpret this balance sheet. Next, we'll go through an example of when a company recognizes revenue, but after they've already received cash from their customers. And here we'll use Southwest Airlines as our example. So suppose you buy a plane ticket on Southwest Airlines for $200, okay? Southwest does get that cash, but they haven't earned it yet, okay? They have not satisfied their performance obligation. What is Southwest's performance obligation? It is getting you from A to B on the airplane, okay? So once the airplane flies, that is when Southwest earns that revenue. When the customer just buys a plane ticket, they collect cash, but they don't earn the revenue. So when this first event happens, Southwest will debit cash for $200, but they haven't earned it yet, so they're going to credit a liability account called deferred revenue for $200. Why is deferred revenue a liability? Well, remember, a liability means that the company has some economic obligation in the future, some economic sacrifice that they'll have to make in the future. What is the economic sacrifice in this case? It's that it costs money to have an airplane and fly somebody from A to B, okay? That's the future economic sacrifice that Southwest will have to make to its customer. Now we're going to watch what happens when Southwest finally settles that obligation. The customer finally uses the ticket, okay? Or the customer misses the flight and his or her right to air travel expires, okay? Well, at this point, Southwest has earned that revenue, okay? The performance obligation's been satisfied. So now they can credit the revenue account in the income statement, and the debit is to deferred revenue, reducing it to zero. So that debit reduces deferred revenue account to zero, and the credit to revenue shows up on the income statement as revenue during the period. Okay? Now let me show you the T account for deferred revenue. Deferred revenue is a liability account, and so it's got its normal balance on the credit side of a T account. It'll have a beginning balance from the prior period. When the company receives cash, they debit cash and credit deferred revenue. So here is that credit to deferred revenue for receiving cash. When the company earns the revenue, satisfies the performance obligation, they debit deferred revenue and credit revenue. So here is that debit to deferred revenue, and the credit is in the revenue T account. And finally, you get to your ending balance, which is also on the credit side. So the beginning balance as a credit plus cash received minus revenue recognized equals the ending balance, which should also be a credit in the deferred revenue liability account. And let's look at Southwest's balance sheet now. So here we have the asset section of the balance sheet on top, which we're not really interested in for Southwest. We're interested in the liability section of their balance sheet. And as of December 31st, 2019, they have this liability called the air traffic liability. And the air traffic liability, that's what Southwest calls deferred revenue. And the balance in this account, December 31st, 2019, is 4457. This is in millions, so it's $4,457,000,000. What does that number represent? It represents cash received from ticket sales, but the customer hasn't flown yet. So the customer is going to fly sometime during 2020, and at that point, Southwest will debit the air traffic liability and credit revenue on the income statement. But they have to wait until they satisfy the performance obligation. Okay? So that's what that balance on Southwest's balance sheet represents. Okay, to recap, we talked about when can a company recognize revenue. Companies recognize revenue when the performance obligation is satisfied. That is, when they earn the revenue. And when revenue is earned, they can record a credit to the revenue account. Okay? When a revenue is earned, you record a credit to the revenue account. What is the debit to? Well, it depends on when you received cash relative to earning the revenue. If you're receiving cash at the same time you're earning revenue, you debit cash. If you receive cash after you earn revenue, you debit accounts receivable. And if you receive cash before you earn revenue, you debit deferred revenue. And finally, we learned about the T accounts for these two important balance sheet accounts of accounts receivable and deferred revenue.